we're increasingly looking like we're cooked. I'm waiting for consensus to realize how cornered we are, and I don't see it yet.
If you view the United States as an empire, like the Roman Empire, then with the interest payments, plus on debt, greater than military expenditures, you're typically at the you've crossed the Rubicon where the U.S. era of global dominance is over.
It's another big down day for the stock markets today as the S&P 500 drops 3%. The Dow is down more than 1,000 points. Gold is up 3%. It's now trading at over $3,400 an ounce. Bitcoin is interestingly up 3% as well, diverging from the stock markets. We'll talk about that. Is it trading now in line with gold? President Trump is now doubling down on his rhetoric against Fed Chair Jerome Powell. He's now calling him a major loser on Truth Social, insinuating that if Chair Powell does not cut interest rates anytime soon, there may be trouble ahead for the economy. What kind of trouble are we looking at? We'll find out with the next two guests, Luke Gromen and James Thorne, popular guests on my show. Luke is the founder and president of Forest for the Trees. James is the chief market strategist at Wellington-Altus Private Wealth. Both have been on my show previously. You can check out their individual interviews with me in the links down below in the description. It's an honor to have both you, Jim, and Luke together on the show together at the same time. Thank you for joining, gentlemen. Welcome to the show.
Thanks for having me back on.
Yeah, thanks for having me.
Okay, well, I'm getting a lot of warnings that the U.S. dollar is in danger. In particular, the status as a global safe haven asset is under threat. You can see this by the decline in the DXY in the last couple of weeks. Typically, well, in the past, not typically, but in the past, when Trump has escalated tariffs, the dollar has risen. Not so much this month. Capital outflows are the name of the game for the dollar. What is your read on what's going on? Why is capital leaving the dollar? Why are bond yields for the 10-year yield going up while yields for other bonds from other countries going down, as an example? Luke, I'll start with you.
I think ultimately, because that's what the Trump administration wants, if you believe what they've been saying, which is if you go back to the late January, Trump came out and was the sentiments were echoed by Bessent, essentially saying, I would like to reverse the flows of capital and trade as they have defined the last 50 years. He said that by virtue of saying, I want to finance via tariffs, not income tax. And then they doubled down in February, which I think is still maybe one of the more underappreciated documents from the U.S. government in years and maybe in decades. Late night, February 21st, Friday night, Trump came out with the America First Investment Policy Memo. And if you read that, it is basically China, take your money and go home. Foreigners, take your money and go home. And when you pair that with the comments from Stephen Myron, of course, he wrote this missive about reordering trade in November of last year. He has since sort of disavowed that, but not really. But more importantly, he stood up in front of the Hudson Institute a couple weeks ago and basically reavowed that statement. But what they all appear to be doing is saying, look, the way the world worked for 50 years was we send our jobs and manufacturing facilities offshore. You guys send us stuff. We send you dollars. You recycle those dollars into U.S. financial assets, and in particular treasuries, and more recently in the last 10 years, the stock market and Mag 7. And what Trump is saying is, look, we don't want you recycling these into financial assets anymore. We are happy to have your capital if you want to invest in American infrastructure. And if we're happy to have your capital here if you want to help rebuild factories. We do not want you bidding the Mag 7 from 50 times sales to 100 times sales anymore. And so we are going to start raising the cost of carry on U.S. financial assets, and in particular treasuries. You can read in this document from February, they're talking about reinstituting a sales tax or a tax on treasuries that had not existed for China for a long time. They're talking about different foreign taxes on foreign investment into U.S. investments. They're basically telling foreign capital, get out of paper assets And one last thing they told people that I don't think was well understood was they tariffed everything. They tariffed an island with penguins on it, apparently.
Yeah.
The one thing they didn't put tariffs on was gold. And so when you kind of put the pieces together without them coming out and saying it explicitly, they're saying, listen, take your money, invest in our factories and our infrastructure and our workforce, or put it in gold. But our deficits are no longer going to be allowed to accrue in our financial markets without a tax on them. And so what you're seeing as an end result of this is this money is leaving. And I think that describes a lot of the price action, which is NASDAQ down, stocks down, bonds down, dollar down, gold up. And I think we're in the second pitch of the first inning of this. Unless something drastically changes. I think this is a tectonic sea change that I think people waiting for it to revert or might be waiting a while.
All right, James, I'll let you respond to this tectonic sea change that Luke is referencing. What does this sea change look like? And going back to my original question, what this mean for the dollar as a safe haven asset?
Well, I think what we've got now is I'll call the official sector realizing that we need to rebalance. When the Brookings Institution comes out with a paper saying we need to rebalance, now they may have a problem with how President Trump and his administration is doing it, but none of this, as far as I'm concerned, should be a surprise. Keynes warned about this at Bretton Woods, right? So Harry Dexter White took the U.S. dollar and tied it to gold and said that the global economy was going to rebalance through WTO or GATT. We know that doesn't work, right? So we've got an extremely unbalanced global economy, and as I've trained as an economist, one of the things that I come up to is that the global economy is closed, which means deficits and surplus must equal, and there is a special place in the world for that economy or that individual or the economy that has the currency that is the medium of exchange of the global economy. It really means over time, and Keynes warned us, is that the United States was going to go from a creditor to a debtor nation. They were going to go from a manufacturer to a consumer. Their standard of living was going to fall, and the rise of populism was going to happen. We're here. Right now, we can argue about the weak dollar. I completely agree with Luke. I think, the first step in getting out of this is having a managed decline of the U.S. dollar. I mean, that's how I view it. I mean, why it's happening, I don't know. As I get older in my life, I say that's the first leg in the stool. We need interest rates down, and we need commodity prices down, specifically energy. And then can we make debt sustainable? I think Luke has touched on this in some of his work. I think there is a significant difference between weak dollar and the U.S. dollar system. And I really suggest that I do not see a new U.S. dollar system. I think, we're going to get with the stable coins and Bitcoin, we're going to get some type of solution. I think also, looking at the movement in the yields over the past couple of weeks, I think what's interesting is, I would suggest that the bond market that we're dealing with today is not my grandfather's bond market, and you have a lot of hedge funds playing out in that space. And I think a lot of them were levered up to try to basically front run deregulation, specifically the supplemental leverage ratio, which would have allowed basically banks to go back in and somewhat act the same way as they did before Dodd-Frank. And there's another demand for U.S. Treasuries. So, how this is evolving is, I see everybody's upset. I would argue, and I would submit, because as I get older in my life, I sit there and I say, what's the game, right? I think if we had another participant here, and his name would be Scott Bessent, right? Everything that Luke and I just dropped on you, right? He knows, right? So you've got some really smart people dealing with this. So the decline in the U.S. dollar, the Dixie, I think it's exactly what we need. Now we got to get the decline in U.S. Treasuries. We've got to get that to a level so that it's sustainable. And then I would argue what we need to do, using World War II as my reference point, All right. I think we need to get nominal GDP higher than inflation, higher than interest rates. We've got to grow our way out of it. And that's what we did after World War II.
How do we get?
So do I like the volatility? No. Am I surprised? No. But it's somewhat evolving the way that I thought it would, having this thesis for such a long period of time.
Before we continue with the interview, let me tell you about the FIRE movement. It stands for Financial Independence, Retire Early. It's a philosophy focused on achieving financial freedom at a younger age through a combination of aggressive saving, smart investing, and mindful spending. While the movement continues to grow in popularity, financial institutions have largely ignored this community until now. And here comes FIRE ETFs, today's sponsor. These are the first ETFs designed specifically to help support the FIRE community. FIRE ETFs have launched 2 complementary funds designed to align with the movement's financial goals. FIRE Funds Wealth Builder ETF, FIRS, seeks to diversify its portfolio across 4 ETF baskets to match prosperity, recession, inflation, and deflation cycles. While the FIRE Funds Income Target ETF, FIRI, seeks to target a minimum 4% annual income level. So if you're looking for ways to support your FIRE journey, well, this is a really cool product to take a look at. Visit fireetfs.com, link down below, or scan the QR code here to learn more. This ad is brought to you by and sponsored by FIRE ETFs. How do we boost nominal GDP? Just a quick follow-up question to you, Jim.
Well, we get inflation is possibly going to be higher than people would suggest, right? And I think, once we get through this period of time where the growth in the United States that was juiced by, President Biden's fiscal spending, we have, AI, we do reshore a little bit in the United States. I don't think there's a major amount that they can do. I think it's critical infrastructure. And, we grow, get interest rates down. There is some demographics, housing, and we just start to grow out of this. I also think the other interesting thing about it is the fact that when you think about the trade deficit, right, the only thing that Trump could really do, and I could be wrong, is the fact that when you're talking to a government, you're really talking about purchases of natural resources, right? China, LNG, what have you. A lot of the deficits and surpluses that have been developed between the United States and the rest of the world is created by the private sector and the supply chains. I just don't see that unwinding in 90 days. Mm-hmm. So I take the different view that Bissent knows what he's doing. Yes, it's very dangerous and critical. Yes, we need to deal with the debt. But I think, the cooler heads are going to prevail. And really what I'm looking at is, what does this thing look like 5 to 6 quarters out? I'll stop there, David.
Speaking of debt, Luke, I'll pass this over to you first. There's another U.S. debt downgrade warning. This comes from S&P Global Ratings. The outcome of the U.S. government's budget process and policy negotiations over the coming months will help determine policies that inform our view of U.S. sovereign credit worthiness. S&P said in one of the recent reports, these discussions could affect our view of the U.S.'s fiscal profile. Would you be surprised if we get a debt downgrade this summer, Luke?
No. I actually would probably be surprised if we don't get one.
Okay. What would be the main catalyst behind a debt downgrade, do you think?
I think it's ultimately a combination of factors of, as we stand today, the trailing 12 months through February, I haven't added in the March numbers yet that just came out, but through February, trailing 12 months, the U.S. interest expense plus entitlement spending alone is over 100% of receipts. And receipts are all-time highs. And receipts on the margin are highly influenced by stock prices. So with what stock prices have done, receipts are going to fall, probably 5 to 10% in the next 12 months. So you're going to have a U.S. federal government that's going to easily have true interest expense. It's interest and interest-like obligations that are 115, 120% of receipts that are falling. And that's if we don't have a recession. which is increasingly looking likely given the disruption that is evolving with the trade war. If that's the case, if we actually have just a plain vanilla recession, we could easily be at 120 to 130% of receipts on interest and interest-like obligations relative to receipts. And that is in no way, in no world is an entity that whose interest and interest-like obligations are running 120% of their receipts. That's junk. That's highly speculative junk. It's not AAA. So that's I like I said, I think it's inevitable. And it's also why I think in the next crisis or as we evolve, I think it's why treasury yields are going to keep rising until they are forcefully capped one way or another.
Okay, James, similar question. I'll let you respond to this debt downgrade, but more importantly for the markets, if we do get a debt downgrade like Luke mentioned, will yields rise? Do you agree with that forecast?
There will be a shock to the system, definitely, like it was, the last time they've been downgraded. But I think Luke, hits the nail on the head. Right? We've got interest expense. It's unsustainable. Something has to happen, right? And in Besant's testimony when he was being confirmed, he even acknowledges, this is I view the I try to trick myself, and come up with these narratives, knowing that they're wrong. But if you view the United States as an empire, like the Roman Empire, then with the interest payments, plus on debt, greater than military expenditures, you're typically at the you've crossed the Rubicon where the U.S. era of global dominance is over, right? And I agree with everything that Luke says. The only thing I would give a caveat to is, I don't think it's as unique a narrative as we think it is. And I would suggest to you that, we need to get interest rates down. I think it's going to be very interesting to see how we deal with the debt. I don't buy in to the Austrian school narrative, right? Or here's the other. I don't buy into, look, if we go back and we know that the global economy is closed, and we know that there are periods of time left to their own devices that it gets significantly unbalanced.
Mm-hmm.
The way that we've dealt with that previously in history is through war. We've wiped out the excess capacity. Really, that's what happened in World War I, and you can think about that in World War II. This is the first time in history that we're dealing with excess capacity, which we're not basically trying to, reconcile it with a world war. And so, it's going to be very unique in how we do things. It's going to feel absolutely terrible. And I don't know, I've been at this game since the mid 90s, right? And, the majority of people that I talked to weren't in the business in 2008. And I'm not saying that as as disrespectful or anything. I just look at where we're going, and we really have to ask ourselves the question, are we basically rudderless and flying the plane into the side of the mountain, right? One, or they know what they're doing. And if they do know what they're doing, are we going to get a new Plaza Accord? Are we going to get a new Bretton Woods? Is Trump going to reverse course quickly? Does he understand the errors of his ways in the Rose Garden? And what does it look going forward? And so I have sided on the view that, Luke may be right, but if rates go higher, that is possibly the last nail in the coffin for over the short period of time, because we just can't afford, given the level of debt globally, to have higher interest rates.
Luke, I think you told me last time you were on the show, which was September 2024, that you can see yields going, the 10-year going back up above 4%. It may not be this year, but actually, if we're looking at the 10-year yield, we are currently at, it's kind of moved in the same direction that you've anticipated. We're above 4%. When you were giving me this forecast, we were still at 3.7. What's your outlook on the 10-year now?
I think it is ultimately going to go to the level. It's going to go higher to the level that creates another round of dysfunction. And I think that might be 4.6%, maybe it's 4.8%. At any rate, I highly doubt it's more than 5%. And at that point, I think we're going to get some version of what we got, to Jim's point, after World War II, which is, either outright explicit yield curve control, which I think will be the last option. I think they really want to avoid that because they'll have to buy the whole bond market because they could cap yields on treasuries, but then spreads on mortgage bonds will blow out, so they'll have to buy all of those, and then spreads on long-term corporate bonds will blow out, so they'll have to buy all of those. So ultimately, I really think they want to avoid doing explicit yield curve control. So I think you'll start to see more instances of soft. It'll start with jawboning, right? And I think we've already gotten the jawboning. When we saw the 10-year go to 4.5%, we had in the span of 72 hours, we had we started with the Fed on Friday, not last Friday, but 2 Fridays ago. Boston Fed said we will absolutely get involved with the bond market if it keeps acting this way. You had Besant talk about it on Sunday, I think on Meet the Press. You had Waller talk about it on Monday at the Fed saying, hey, it's like the tush push. Inflation is transitory here again. Let's just try again. And then you had the number 2 at Treasury. I can't think of his name, but at any rate, saying that they are having discussions around the bond market and suspension or exemption of treasuries for SLR again, to Jim's point. So that was the jawboning of the Treasury market. And sooner or later, markets are what they are. They're going to test these policymakers because the fundamental supply demand, particularly given what we're seeing, which is the policy of this government is saying, take your money and go home. That's going to continue to put downward pressure on dollar, downward pressure on selling pressure on bonds, upward pressure on yields. As the economy slows, as the stock market falls, Besant's going to have to come out and say, well, that QRA, the quarterly refunding, the amount we're going to have to borrow in the third quarter and fourth quarters, is actually a lot more than we thought. And it's one of these things is going to trigger, I think, us up to that 4.5, 4.6, maybe a little higher in the 10-year. And then they're going to have to get more explicit. The policymakers, are going to have to get more explicit with yield curve control. However that looks like, it probably won't be called yield curve control. My guess is it'll be something around treasury market functioning or something like that. So it doesn't sound like they're printing the money to finance the government, but that'll be essentially what they're doing, which again is fine. We're in the middle of a restructuring. This is how this goes. Jim had a great point about the end of World War II. I put a chart up yesterday on X that shows that in the 10 years after World War II, real rates around the world, the least negative real rate was America at negative 14%. The losers in that war had negative real rates that bottomed at negative 60 to 70%, 60 to 7. So basically, they inflated the debt away really fast. And so we're going to do some version of that. And that's how I think that's what they're going to have to do. So to me, the level of the 10-year is less interesting than the ultimate level of where real rates bottom at. How negative are they? How many double digits is it? I think it's going to be at least negative 10% for a span of years in the West.
Okay. Jim, I'll let you respond to that. Your outlook for yields.
Oh, yeah. We need to get negative rates, right? And I think real rates. And I think, you look at where we are relative to the Fed and the PCE. I mean, it's silly where they are, right? So we need that's so when you think about, David, when you say, when inflation is greater than the interest rates for like say the overnight rate, that's negative rates. We need negative rates. There's no two ways about it, right? And so the only thing I would disagree with, it's not a disagreement, is you ask the question. Well, look, here's the thing, the fly in the ointment for me, it was the fact that what is interesting about, and Luke brought it up, is, with what was said late February is, look, if the president really wants to do this, if this is what the states want, then this cannot be done through an executive order. And what needs to happen is he needs to basically, this is unconstitutional, actually, right? The power of the purse, if you think tariffs are a tax, the power of the purse goes with the House and the Senate, right? And so if you look at it that way, why are they doing this? Why are they basically wanting the market to correct and to have and exacerbate the growth? Well, why not front end load economic growth slowdown and a correction get everything out of the way in the first 100 days, and then have a real strong economy and stock market and financial markets going into the midterm elections with the hope of getting 60, getting that 60% or 60 seat majority in the Senate, given the fact that you've got AOC and Bernie Sanders and the Dems blowing up. Yeah. And then you really go for the gusto and you actually put this into law, right? Because, even Brookings is coming out with the fact saying, guys, these are EOs. And he's way over the skis saying that, look, I'm sorry, David, Luke, right? Quebec cheese is not a matter of national security. Right? Quebec milk isn't a matter of national security. I get the H20 for NVIDIA and the Hopper, right? And AI. So I am looking at this, asking the questions, why are they being so toned down? Well, maybe what they're trying to do is they're trying to basically, short circuit what we would call the presidential cycle, the 4-year presidential cycle, which speaks to a slow economy and slow asset prices in 26. Now, do I have anything to hang my hat on that? Of course I don't, right? It's conjecture. It's a narrative. But there's got to be a reason why they're acting so, shall I say, with a lack of foresight with what they're doing with the tariffs right now. I'll put it that way.
I'm going to shift gears now and talk about monetary policy. This came in just today on Monday from Donald Trump, on Truth Social. Preemptive cuts in interest rates are being called for by many, with energy costs way down, food prices, including Biden's egg disaster, substantially lower, and most other things trending down. There's virtually no inflation. With these costs trending so nicely downward, just what I predicted they would do so, there can be almost no inflation, but there can be slowing of the economy unless Mr. Too Late, he's talking about Powell, Mr. Too Late, a major loser, lowers interest rates now. Europe has already lowered 7 times. Powell has always been too late, except when it comes to the election period, when he lowered in order to help Sleepy Joe. All right, what's your response to this? Luke, I'll let you go first.
I think the thing people aren't looking at yet is arguing the counterfactual to that statement, which is the Europeans lowered 7 times or whatever he said. I have not counted those up. I'm assuming that's correct, but let's assume it's right. The Europeans have lowered 7 times and the dollar's falling like a stone against the euro. What happens if Powell cuts 5 times from here? Or does an emergency cut? I mean, we're going to have the dollar down in the low 90s before anyone can even. And so I think ultimately this is the goal. I think ultimately what he wants, some people have speculated that Besant will create a run on the PBOC like he did on the Bank of England. I think he's causing a run on the Fed. I think it's his force. Powell won't play ball. We will just tank things and we'll do things. And then once the bond market breaks, which took a grand total of 4.5 days after he announced the tariffs, then Powell will have to play ball. And we'll just, because at the end of the day, Powell can't be the Fed chairman that lets a treasury auction fail. And so I think they are involved in a very big game of chicken around who's going to blink first. And I think Powell has his interests. I don't think Trump is wrong that they lowered rates to try to help the election. I think it was ultimately because the bond market was starting to have some problems in the fall. I think the timing looked terrible, certainly as it related to the election. But I think ultimately, to Jim's point, they want to front end load this thing. And so I think they want to get the dollar down a lot. And so I think they'd like to see that because, look, he can say all these about inflation. Inflation's about to get a lot worse.
Jim,
this interruption, inflation's going way higher.
Yeah. Okay. So inflation's. Wait. Sorry. Before we move on to Jim, why? Okay. Inflation's going to move a lot higher. Why is Trump, I guess, wrong in his assessment that inflation is going to stay low? clearly he doesn't think the tariffs will cause inflation. I mean, are you looking at the tariffs as a cause for inflation, or are you looking at something else here?
Absolutely. I'm looking at what they have done. We know if the United States government runs a $2 trillion plus surplus and they disrupt supply chains, and then you cut rates into it and you suppress treasury market volatility, that's pretty much to a T what happened with COVID. That was COVID. And so fast forward to today, 5 years later, what do we have? We have the United States government running $2 trillion plus deficits. It's probably going to be a $2.5 trillion deficit or more on an annualized run rate by the end of this year. You're interrupting global supply chains very severely. You're suppressing treasury market volatility. And you've possibly got the Fed cutting rates. What do I think Trump's wrong? I think Trump's looking at the rearview window because he has to. Because if he, what's the world going to say if he comes out and says, hey, we got inflation down and in the next 2 years, inflation's going to 10% again? He can't say that. So, and half the country wouldn't believe him if he did say it, and half the country would. So which is part of the problem, is the divisiveness of this country. That's neither here nor there. So, yeah, I think inflation's going significantly higher, but I think they're just trying to front load, get the dollar down so that we can sort of start reflating and we can start reshoring, I think is the plan.
Jim, here's the CME Fed Watch. So similar question. So no change in the rates is expected by the CME Fed Watch, so the bond market in particular. So I guess people either think people either think that Powell is not a loser or that he's not going to be Mr. Too Late. Anyway, what's your interpretation? Is Powell going to cut rates come May?
Maybe not May, but June. I think right now he should be at R-star, right? He should be at the neutral.
Yeah.
And where I would add just to the conversation that Luke brought up is I would add, maybe it's a good thing that we get inflation, because there's a lot of, foundational deflationary pressures that, are getting stronger, right? And, excessive levels of debt are deflationary. So the way I look at this, if you go back to pre-COVID, right? I mean, it was secular stagnation, pushing on a string. We couldn't get inflation higher. And my argument had always been, look, this is their chance to get inflation. They couldn't get it, right? We've finally broken the curse of, Alvin Hansen's secular stagnation. Don't grasp defeat from the jaws of victory, And so I would suggest, I hope, we need inflation to grow our way out of this. Am I saying 10% inflation? No, but we need to have nominal GDP higher than inflation, and higher than inflation is, higher than interest rates. And so, even so, the way I look at it is we somehow have forgotten that there are existing deflationary pressures in this environment, and the global economy does have excess capacity. And, what is secular stagnation? It's really, it's a lack of demand, right? So the way I look at this is, look, I think interest rates, I look out 5 to 6 quarters. And so I think interest rates are going to go down into 27, rightly or wrongly. And then what we really have to do is you have to sit there and you have to ask yourself, okay, what does this look like into the end of the decade and into the new decade? And Luke might be absolutely right that we're in this inflationary environment, right? I kind of position this as the echo of COVID, and we're going to go down lower than I think people expect. And the other thing that was interesting, and I'll just talk about being up here, so I'm a buy side guy. That's why I don't change my views very much. Worked in the States for 25 years. I'm up here in Canada. Okay. I'm in Toronto. But what I find interesting is, the Fed fund, or the Bank of Canada rates basically at R-star right now. Right. And we're going through a balance sheet recession up here. Right. There is no kickback. This is, we're going back. We're walking into pushing on a string, right? The flat LM curve. Right. Folks up here don't understand that. But here's the difference, though. I think America isn't in the same position because of the strength of the consumer. They're not as levered up. It's going to be very interesting to see what happens when rates come down. So rates come down in Canada and Europe. I don't see this fantastic reacceleration. It's going to be very interesting to see if rates go down to 2.5 or 2.75, let's say R star. What is the kick? How does the private sector kick in? And Luke might be right. We may have inflation, but you know what? I think that's more desirable than secular stagnation. And the thing that's interesting, David, is if you go back to the 45, right, coming out of World War II, and I got this from Bernay. Well, one of the things I hate about living up here, not living in DC, is not being able to go to these presentations and hearing these guys talk after the PowerPoint presentation. It was Bernanke who was talking to a bunch of guys, and he said, look, this is like post World War II. And what was the interesting thing about what he said is they contracted the balance sheet. They thought they were going back. They thought that they were going back to the 30s. Right? They thought that they were going back to secular stagnation and deflation in the 1930s. And that's why they ramped back up the Fed's balance sheet and they didn't really touch it. Now, I'm paraphrasing that. So I am looking this as an intermediate phase. We're going to go back down. There is definitely inflationary pressures, but I think they would be desirable. I don't know how we get out of this without inflation.
Okay, let's talk about some solutions to rising debt that I like to run by you. Here's one interesting one: Bitbonds, a $2 trillion idea that could slash the national debt. This is reported on Forbes. How do they work? All right, Bitbonds are like regular bonds in the sense that the Treasury would allocate 90% of the bonds to fund the government, but it would then use the remaining 10% of the funds to purchase Bitcoin. So let's say you issue $2 trillion of these Bitcoin bonds. Approximately 20% of the 2025 refinancing needs to be met through Bitbonds. $100 issued, $10 buys Bitcoin. Upon maturity, investors will receive 100% of the Bitcoin upside, up to 4.5% of the total compounded return. After this benchmark is reached, investors would receive 50% of all remaining Bitcoin upside. Meanwhile, the government would keep the other 50% of remaining Bitcoin upside to supply strategic Bitcoin reserve. I think it's taking inspiration from Michael Saylor's convertible bonds. Anyway, do you have any views on this, Luke? I'll let you go first.
I think in a vacuum it would work. The problem is I think it ignores the political economic reality, which is by them doing that, it would effectively make Bitcoin, the new neutral reserve asset effectively, which I'm not saying is a bad thing. It might be a good thing. It would, because why would I own those bonds if I can just go buy Bitcoin? Why do I want, I would rather have 100% of the upside, and just own the Bitcoin and just cut the government right out. Why even bother with the middleman? And so I think the political economic side of it will be tricky to manage. I do think there's a role for using Bitcoin, stable coins, financing because at the end of the day, you need to find somebody who will buy U.S. government bonds at as negative a real rate as possible. And so if you make Bitcoin big enough and then you mandate stablecoin reserves of a certain level relative to the market cap of Bitcoin, and then you mandate that stablecoins have a reserve base of a certain percentage of T-bills, now you've created for yourself a captive audience in stablecoins, where stablecoins are paying 0%, they're getting 5%. The government can sort of compress that down. They don't have to pay the stablecoins very much if they want to cut rates down. That would work. But the Bitbond, the concept works in terms of, it mirrors something Judy Shelton has talked about with gold, which is essentially, you have a small part of the coupon in gold. And I think that would be the better construction, which is, look, take 5% of the face value of the bond, straight Bitcoin. And whatever you get, you get. And I will now, would I own a bond with a 2.5%, a 10-year bond where 5% or 10% of the face was 100% Bitcoin with 100% of the upside? Yes. because now that takes away or compensates me for what we know mathematically must happen, which is the U.S. government's going to have to inflate the debt away. They're in negative real rates for some period of time. So you can do it with gold, you can do it with Bitcoin. I think that's unnecessarily complex about, 4.5%, kind of like just put 10% of it in Bitcoin as a kicker, as a sweetener, and now you can lower the coupon down to 2 on or to 1 on a 30-year piece of paper. That would work. That still gets into the political economy side of, until Bitcoin prices are high enough, Bitcoin is sort of the de facto reserve asset of the world if the U.S. government does that. So that's the tricky side of it.
Okay. What do you think, Jim? Do you like this idea? Do you have a better idea?
Oh, I think it's very interesting. When Lou's talking about it, I hearken back to '08 with Freddie and Fannie blowing up and them being instructed to go out and buy all these mortgage-backed securities at par, not at 10 cents on the dollar, at par, and then write them off. And you're sitting there in DC, and when this is happening, what's going on? You're saying, well, you're taking care of your customer, aren't you? You're basically, the customer bought these subprime pieces of garbage. We got to make it whole because they'll never buy anything from us again. And so there's my bias, David. What are we going to do to save the franchise, which is U.S. Treasuries as the medium of exchange, as the gold standard, so to speak, of the store of value. And we could argue whether or not what President Biden and Secretary Yellen did in Ukraine during the war and all that. But what we need is something to anchor the U.S. dollar and the U.S. Treasury, and we need to create an environment that makes it attractive for folks to want to purchase all this debt that needs to be refinanced. Is it these bonds? I think I watched Luke talk about the fact that the stable coin might initiate in a new era of the petrodollar, which is a brilliant, what we did back in the 70s to recycle. That's a brilliant idea. I think there's going to be a multitude of ideas that are going to be put forward to ensure that the franchise, which is the U.S. Treasury as the number one position for a store of value, holds, because it needs to hold. Because if it doesn't hold, what happens, right? We've got so much debt that we've got to refinance. And so it could, right? It could. I like Bitcoin. I like gold. I think this is what we're going to go through. But to me, it's, I think it's part and parcel of the type of environment we're in, where, ideas are going to be floated. And I think the interesting thing is, as we talked about from the get-go, is we're not going back to business as usual. This is too big, what we're going through. We're going through a generational adjustment. Historians are going to write about this. This is circa, this is Bretton Woods 45, or, go back to, the greenback, Alexander Hamilton after the Revolutionary War. It's that big. And so do I know exactly what it's going to be? No. But I would suggest to you that the U.S. dollar is still going to be the medium of exchange of the global economy, and the U.S. Treasury will still have the pole position. Now, I would expect negative rates to go back to Europe. Look at the rates going in China, where debt deflation spiral. The rates are starting to come back down in China. All we really need to do is to basically maintain where we are right now, let the other interest rates go down, which is what's happening. And, the U.S. Treasury start to become more attractive on that basis as well. So it's going to be difficult. We're in a sea of change, but, never say never. But I do think, I think there is going to be a new global monetary system. It will be negotiated, and I would not be surprised if gold and stable coins and Bitcoin have some partner. Is it the IMF and special drawing rights? I have no clue. But we can't go on the way we are right now, David.
Okay, I want to finish off on markets. So just today, the S&P is down about 3%. The Dow dropped about 1,000 points. Gold is up 3% to it's now higher than $3,400. Bitcoin's up about 3%. It's interesting because Bitcoin and the stock markets have kind of been decoupling ever since the beginning of April, or middle of April rather. Yeah, first, second week of April. So that's interesting. Given your analysis, I think you're both on the same page on the macro front. Higher inflation, perhaps higher yields, and higher levels of debt being a problem. What should we do with our portfolios? Is my question. And I'll leave this up on the screen just so you can take a look at it. Luke, I'll let you go first.
I think until you get any clarity, what we've been saying is the only thing we have any conviction in is gold and T-bills in terms of marginal capital.
Even at $3,400 an ounce, Luke?
Oh, absolutely. Absolutely. I don't think people realize how bad this could get. And I would phrase that by saying, what asset do you own the day it is announced that a major U.S. defense manufacturer has to shut down production for lack of Chinese rare earths? Because that day is coming in the next 3 to 6 months. And I don't know what to own in that case, other than gold and T-bills. And so that's like that. These are the stakes we're now playing at. So, yeah, I think ultimately, I put up a post earlier today. If you look at with gold having done what it's done, it is now the market value of U.S. official gold as a percent of foreign held treasuries is now 10%. In 1989, that number was 20%. So gold would have to double from here just to get back to 1989 levels. The long-term average is 40%. The U.S., well, that's how much foreign debt we now have. Gold would have to quadruple just to get back to the long-term average. If we have an honest-to-goodness dollar crisis, I don't think we're gonna. We're walking down that path. We have a ways to go yet, but I don't think if we actually have an honest-to-goodness dollar crisis, the market value of U.S. official gold collateralized the foreign-held portion of our debt at 135% in 1980. So I think that the gold, I think, is still going way higher. And I think, it kind of ties into Jim's prior point of what do we need to do to reattract capital to the treasury market, defend the franchise. And as a friend of mine likes to say, if you're going to take Vienna, right? If you're going to do something, which is, look, as I own gold. I would be happy to buy a lot of 10-year treasury bonds, 30-year treasury bonds at 4% if the value of the dollar in gold terms is appropriate. What's appropriate? We can start to have a discussion about that at the 1989 valuation of U.S. official gold relative to our foreign held treasuries, or $7,000. I feel much better about the long-term average unless things get worse, in which case I'm going to need more than the long-term average. So at $12,000 plus, I will be a happy seller of gold and buyer of 10 or 30-year treasury bonds at 4%. Short of that, I don't see any, I don't buy assets where the seller needs me to lose money on a real basis just for them to avoid defaulting, which is what we're discussing here.
Just a quick follow-up before we move to Jim. Luke, so what needs to happen for you as a gold investor to take some profits in the long term? So let's suppose you're right, gold's going much higher. Do we take profits at $7,000, or do we take profits before that if something macro-related changes? Let's say Trump reverses course completely. Let's say tariffs are off the table. Let's say uncertainty is off the table. You know what I'm saying?
Sure. I think it depends how the uncertainty is resolved. I think if it's resolved in extremis by, Xi being overthrown, Putin being overthrown, a version of Yeltsin being installed in both countries who proceed to sell their assets to the Americans on the cheap at, only in dollars, then I'm a seller of gold all day long. I don't think either of those things are going to happen at one end. And so at the other end, I think it's really around price of gold, implementation of policy, right? If the United States comes out and it turns out these UAP energy technology things or whatever we're discussing, these UFOs are actually our stuff, and we're going to be able to roll out over the next 6 to 12 months some sort of energy revolution, I take profits in gold there too. And I would expect gold to be limit down, to be honest,
Yeah.
in that case. But failing those two things, we're increasingly looking like we're cooked. Like the last thing I guess I would say is it would just be relative value, right? If gold stays here at 3,500 and the S&P goes back to 1,000, I'd probably take some profits there. Relatively speaking, looking to buy some good American franchises on the cheap with gold that has held its value. So it depends on how you get there, but I'm waiting for consensus to realize how cornered we are, and I don't see it yet. And so at the end of the day, I'm waiting for that recognition.
Jim, are you aligned with that forecast for cooked? And if so, what do we do? What do we do with our portfolios?
So hey, David, are you in Vancouver?
I am. Yeah.
If Luke is right, boy oh boy is Vancouver. That the home of junior mining gold stocks is going to fly. It's going to absolutely fly. I think gold by the end of 28 is going to be 5,000. Right, easy. It could go much higher. I think the plume is off the rose in terms of I think everybody knows that the jig is up with fiat money and the unsustainable debt. I look at this more of inputs and starts. And so I think, with China, with basically a fixed exchange rate and a closed capital account, but I think I'm going to be wrong, but about 50% of their debt, external debt denominated in the United States and debt deflation spiral, I think a deal is going to be made. And that deal will provide a relief rally. The other thing I would add to that is that, the way I look at this is I try to overlay the 90s or Japan and the fact that, we've heard this, or at least in my lifetime, I've heard this is a matter of national security. It was the Japanese in coming out of the 1980s. They had all the technology. They had all the chips. A lot of the policies that we're seeing right now were implemented against Japan. Yeah. Is it different? Yes. Japan is an ally militarily. But I would still sit there and say to you that we are still way early in this phase about innovation in terms of AI and blockchain. And so I would suggest to you that a period of time where we're going to go back to innovation. And what I would say is this, and I'm just going to steal, the thunder of Druckenmiller, right? I steal stuff from Luke. I steal stuff from everybody, right? Because I'm still learning. But, Druckenmiller said a couple of things. One is, don't fight fund. If the Fed starts cutting rates aggressively, we know we've got the dollar down, then we're going to have a lot of liquidity. If we have a global reflation cycle, then risk assets are going to go on. And we know that all you have to do is overlay, M2. And, I think Powell does that, with his big, you overlay it and you get, what works in a period of time of reflation. Well, first, what's different this time is gold is finally working the way that we thought it would for decades, right? So that's great. And then I would add Bitcoin in the NASDAQ 100. And I think we're going to go and we're going to have a relief rally. And I honestly really do think if this plays out the way that I'm thinking, I really wonder think about what would happen if there is a super majority in the House and the Senate for, and their MAGA people, right? And Trump gets to start implementing a lot of these things in law, right? He can change the Constitution, folks. He could get it as Bannon's talking about another term. Like the world, we think it's bad now when he's doing EOs. Imagine if he had control of the House and Senate with a super majority. And I think he might be trying to do that. And if he does, I would be really concerned after that. So the 4-year cycle seems to be, and the 60-year cycle seems to be up for negotiation because I think he's trying to really circumvent and short circuit the system and really start to put into place laws that aren't going to be able to be short circuited by the new administration or the Supreme Court or some lower level judge in Washington, D.C. So that's sort of, what I'm asking, if we were just sitting around the table having a cup of, what are they doing? Like, this is insane. They shouldn't be doing like the stuff in the Rose Garden was just wrong. right? It's bad economics. Why is he going after Powell? That's not cause, right? It's not. I mean, so is he stupid? Is the president and his team as dumb as a box of rocks? No. What's the game? And so I think we're going to have a relief rally here. And if that's the case, gold works, Bitcoin works, the NASDAQ 100 works, dollar goes down. And then I think as long as the U.S. interest rates are high relative to the rest of the world, then we start to get ourselves a situation where we can start to make this sustainable. And I think we got to hammer this home. Negative rates are needed. We need negative rates. And so I think the question I would put is, what are we going to go back to a period of time that it looks like the 1950s, right? Because it's that type of, that's what we're talking about. This era of quantitative easing and the Fed being in control of everything is over as far as I'm concerned. We got to get through that. So I am constructive on the markets because I think there's going to be a short-term deal. Mm-hmm. And that short-term deal will be lip service. It'll be putting lipstick on a pig. It will not solve the big structural issues. And I think those are on the come line that are going to come later in the decade. That's how I'm looking at it.
Final question to both of you, because we didn't talk about this much. Your longer-term outlook for the S&P. I'll start with you, Jim. I believe you were constructive on the S&P longer term, right? Post 2027.
Yes, it's basically, I'm going to just use, demographics are king. And typically when we have a massive cohort of brand new individuals coming in and saving for their retirement and family formation, it's nothing profound. I think we're in a secular bull market until the end of the decade. I think all I'm disagreeing with Luke is I think I want to push out the end of the world. I don't use the end of the world, not in a disrespectful way, but that come to Jesus event, I think is early in the next decade. It's coming. I'm just arguing about time. So I think we're gonna rally here. We're gonna have other hiccups like this, and I think we're going to move higher into the end of the decade based on demographics.
Luke, your longer term outlook for equities?
Yeah, I'm ultimately bullish as well. It's for the reason I think Jim really highlighted, which is ultimately, in the short run, I'm very bearish. Mainly because I think the only way we're going to get a deal is if Trump backs down to China. And I think if he I don't think that's going to happen. And B, I think there's a whole lot of people that will have to revisit long, very tightly held worldviews if Trump and the United States have to back down to China visibly. So that's why I'm so cautious near term to say the gold and T-bills and little else with marginal capital. Longer term, I think the way this movie ends is with the U.S. dollar, where are we at, 98 today? I think it ends with the dollar in the 70s or even lower on the DXY. And to Jim's point, that is a tidal wave of liquidity when you've got a world that has borrowed in dollars. That's a world that's great for EM. It's great for EM banks. It's great for gold. It's great for Bitcoin. It's great for stocks. It's great for the global economy. And it helps you get that nominal growth above rates type of environment. So longer term, I'm bullish, but I think I'm in the near term very cautious based on just some of the dynamics I'm seeing and some of the supply chain breakdown that I'm seeing.
Okay, great. I really appreciate both of your time. Thank you very much. Where can we learn more from you? Luke, let's start with you. Where can we find you?
Absolutely. You can find website fftt-llc.com for more information about our mass market and institutional products, and of course on X at Luke Gromen, LukeGromen.
All right. And Jim?
I'm on X at Dr. Strategy, and come to our website, Wellington-Altus.ca.
Okay. Appreciate it, both of you. We'll put the links down below, so make sure to follow Luke and Jim down there. Thank you very much. We'll speak again soon. Take care for now.